Anyway, so recognize that when I kind of do these little run-throughs of some of the chapter material, I'm not covering all the chapter material. So like, for example, this chapter, they spend a lot of the, if you've read through the textbook, a lot of the first pages of the chapter talking about all these principles of internal control. And those principles of internal control are important, but I don't really think they need a lot of review. Like, they're just sort of like, you know how there's like knowledge information that you just have to like read about, and then there's like, you know, how do I do something information. And so a lot of the stuff that I consider just knowledge stuff that you're going to pull out of the book, you know, name the 6 principles of internal or whatever, like, I figure you have that, you know, and of course, if people have questions, you can still ask me, but I don't spend a lot of time covering it. And so I try to focus on the sort of stuff that we're going to have to figure out how we go about actually creating the journal entries and so forth. I feel like our time's usually better spent in that way. So just don't think you can just watch this, you know, this little video and then be like, oh, I got the whole section covered. You still have to read through the textbook. And I said read through because I don't think anybody wants to read a textbook like it's a novel, unless you just are really into it. Like, I don't know, people taking the textbook into the bathroom and just really, you know, reading about petty cash until your legs fall asleep. Maybe, I don't know. But not me. All right, so there's a couple things here. The first thing we have is what's called a petty cash fund. And so this is pretty normal. A lot of businesses, the idea is that sometimes you just need a little bit of cash around for like basic things, like grabbing some office supplies that you don't have in the office supply storage, or, you know, everybody decides we're going to have a pizza party and the boss says, yeah, we can do it. And so instead of having to like go down to like the finance department and have them cut a check, you can just grab some money out of the petty cash fund and pay for those things. So from the business's perspective, the petty cash fund is an asset. And we establish it simply by, I mean, like physically, you usually have like a little metal box. I think I have one in my drawer over here. I could show you. So I do the funds for like our local soccer club. And, you know, I always keep a couple $100 in there. So if I need stamps or something, I can just go grab them. Anyway, so when we created that, I physically went and got $200 from the bank and put it in the box, and then did a journal entry in our books to debit petty cash. So increase that asset, petty cash, and credit cash, so decrease the money from our checking account. That's how I established the petty cash fund. Then what happens is throughout the month, we just, anytime someone pulls money out of the petty cash fund, a lot of companies actually have like a little form. I've seen ones that are as simple as like a scrap of paper, like you write on it who took the money out, what it was for, and how much. Okay. But a lot of places have a form to make sure they have the info they need. And so this on the screen right now, oh, I'm not sharing my screen. You're probably wondering what I'm talking about. Or am I? Yeah, I am. All right, sorry. All right, so this is just a list of all like the cash payments during a period. So this looks like the month of November. They took out 1505. Transport of merchandise purchased. That's a fancy way of saying we like paid for FedEx or something. Purchased of office supplies that were immediately used, customers package delivered, tile cleaning. So at the end of the month, they go, hey, we spent $71.30 out of the petty cash fund. Okay. And so at that point, what you do is you reimburse the petty cash fund. So this is a little bit, this is where it's a little bit weird. So the petty cash fund is like a special type of asset account that we call an impressed fund. Not impressed like it really, you know, it's really excited about those shiny white teeth you have. It's not impressed with you. It's impressed meaning we enter a debit entry to establish the fund, and then we never actually record anything coming out of the fund. So whenever we actually go at the end of the month to replenish the money in the petty cash fund, all we're going to do is debit each of the accounts necessary for those items that we spent money on, and then we're going to credit cash. So in essence, we're pulling cash out of our cash account, $71.30, putting it back into the metal box, and then recording all of the expenses. And this one of them was for merchandise inventory too. All of the expenses and other costs straight in the journal entry. So just, I guess the only takeaway you need to know is whenever you're replenishing your petty cash fund, you don't worry about, because in theory, what you could do is you could do a debit to each of these accounts: merchandise inventory, office supplies, delivery expense, miscellaneous expense, and then a credit to petty cash, and then do another entry which would debit petty cash and credit cash, but we're just skipping that step and we're not ever going to even enter anything. So think about this. When we established the fund, our petty cash account had $75 in it. We spent a bunch of money out of our petty cash fund, but on our books, it still shows $75 in that petty cash fund because we never did a journal entry as we spent. Then at the end of the month, when we reimburse the petty cash fund, we're just going to go ahead and record those expenses and take that money out of cash. So on the books, our petty cash fund still shows a $75 balance. So that's the thing that's a little weird about this. So I'm going to move on to, well, one more concept with petty cash. So if we decide, hey, in this case, having $75 in our petty cash fund isn't enough, then we can just do an entry to increase the petty cash fund. We would debit petty cash $25 and credit cash. And conversely, if we decide, hey, we don't need $75 in that petty cash fund, or it's too much risk having that much in there, we can do a journal entry that does the opposite. We can debit cash, so pull money out of petty cash and put it back into our checking account or our cash fund. Sometimes the petty cash fund, I know you don't believe this, but it will come out off a little bit. So the end of the month, we'll tally up all of the little papers or receipts people have put in there for cash they spent, and we'll find out we're short, meaning probably somebody paid for something with it and accidentally stuck the change in their pocket. Like, it just happens, right? There's a reason we try not to use cash as much as possible, because even good people make honest mistakes. And so if our petty cash fund comes out over or short, then at the end of the month, when we're doing our reimbursement entry, you can see here we're debiting expense and crediting cash. If there's a difference between the expenses and the cash, then we're going to debit an account called cash over and short. So just know if our expenses don't add up to the amount of cash that's missing, then we're going to debit cash over and short. And if it's the other way around, if we have more expenses than the amount of cash that's missing, then we're going to credit the cash over and short account. I remember this just because expenses are debited. So if we're having to pay out extra money, so to speak, then that's going to be a debit. It's going to be a kind of expense. And revenues are credited. So if it's the opposite, if we have more expenses, in other words, if we have extra cash, then we're going to credit that account. So that's the process. I think when you work on a couple of them, maybe you already have, you'll find that they're pretty easy overall. All right, so I'm moving on to a new topic. Any questions about petty cash funds? All right, so either I'm an incredible explainer of things, or you haven't really looked at it yet, so you're like, I don't know how to formulate a question about it yet, or you just honestly don't care about petty cash funds, which that there's a good chance that's, I won't say don't care. I would say of all the things you have to be concerned about in life, maybe petty cash funds is low on the list. How about that? So the other thing that's new this chapter is bank statement reconciliation.
I have a quick question. Sorry.
Oh, I'm sorry. I already moved on. No.
The cash over, cash short, that's only used for petty cash journaling.
Uh-huh.
Okay,
Yeah.
that was my clarification.
Yeah, and only if you're over or short. So if you have the exact amount, then no worries. You don't have to worry about over or short.
Okay. I was just wondering, like with bank statement stuff, when, you know, they are a little bit over or a little bit short, we never use that though. It's only the petty
No,
cash.
most businesses that I work with, I tell them to create an account that we call Ask My Accountant. And so whenever they're not sure, they like put that entry like into Ask My Accountant, and then we try to fix it when, you know, because they're usually operating all the time and they don't want to pay me tons of money. But you know, if I you know, maybe, you know, once a period or something, they'll come spend a couple hours or an hour, and most of it's easy stuff to fix. But so just, I guess what I'm saying is many businesses have some form of something like this where they're saying we're off a little and we're not sure why. So we're gonna kind of put a pin in that and ask somebody about it when we're looking at it. But usually that cash over, cash short is just for petty cash. All right. Okay. So the other thing is what's called a bank reconciliation. Most modern software systems we're using now reconcile kind of on the fly, meaning we don't go through this official process as much. Although I think there's still value in it, and there's certainly value in understanding the process of it and understanding how money flows through cash accounts. So it's interesting, you know, depending on the age of my students. So here, like at Eastern Arizona College, where I teach full time, I have almost all what you'd call traditional students, you know, ages 18 to 24. And many of them have like seriously never seen a bank statement. They just don't. I mean, they have checking accounts, but their phone sends them a text each time there's a withdrawal, and they just kind of keep, you know, and it tells them their balance, and they don't worry about this. So I'm going to go through this a little bit, like it'll be obvious to some of you who've looked at bank statements, and to others it might seem like new material. So here's a bank statement. It has the date on it. It has the balance from the last statement, and then it has any money that's left the account, which it often calls debits, and any money that's come into the account, which it calls credits. And then it has a current balance. That's the balance as of the date on the statement. And then it will have detail of all the checks and debits, and detail of all the deposits and credits. Okay, I mean, and some have different things, but these are generally the things that a bank statement has. One point of clarification: some people say, wait a minute, if this is a deposit into my account, why is it a credit? Because cash increases with a debit. And I would say you're right, cash does increase with a debit and decrease with a credit, but the bank, they don't care about your perspective, they're thinking from their perspective. And remember that anytime you give money to the bank, so if you go deposit money in your account, you're actually loaning that money to them, right? They're on the hook. They have to produce that money when you want that money back. So to a bank, whenever you deposit money in your account, that's a credit to them. That's an increase to a current liability. So that's why deposits in your bank account are called credits, because from the bank statement, they're crediting a liability account. Maybe that'll come up like in a Trivial Pursuit game or something. You can show how smart you are. Really, I think getting a college education, right, is like 20% getting the credential you need for a job, and like 80% stuff you could whip out in trivia games. Like that was pretty cynical. I didn't mean that. Like I value the fact that I was able to go to school. It's given me a lot. But it was a joke, people. All right. Anyway, so the purpose of bank reconciliation is to make sure our records, our books is the term that they'll use, match up with the bank's records. The problem with that is like the numbers are never going to match. So we have to reconcile them. The reason they don't match is because sometimes we will deposit money in the bank right near the end of the month. And so even though we've recorded that deposit on our books, it's not yet showing up on the bank statement when we get it. Sometimes we'll have outstanding checks. I don't know if you ever had this happen. You write a check and you give to somebody. Also, many of my students have never written a check ever in their life because They just use debit cards for everything. So, but you write a check, you give it to someone, and they like stick it in their wallet, and then like a month later, it still hasn't cleared your account, and you're like, dude, like, I hate when like one catches me by surprise. Would you go ahead and like deposit that check? And even if someone deposits the check right away, there's usually a natural lag time. It takes a day or two for the bank, you know, because what happens is when they deposit the check in their account, then their bank reaches out to your bank and says, hey, I want to draw this money, and then their bank will electronically transfer those funds, and there's a lag. So you, again, as soon as you write the check, you usually record it in your books, but it may not show up in your bank account for a few days. And if a bank statement is printed in the interim, it's not going to have that check on it that you wrote and recorded in your book. Sometimes there are bank errors. You get your bank statement back and you look at it and you're like, whoa, this says I wrote the check for, you know, a certain amount, but that's not what I have on my records. And so you have to get that fixed. So the cash balance on the bank statement, plus any deposits in transit, those are deposits you've made but that aren't yet showing on the bank account, minus any outstanding checks, those are checks you've written but aren't yet showing up on the bank statement, plus or minus any bank errors, is going to give us an adjusted cash balance per the bank. Sometimes I call it adjusted bank balance. Then we have to look at our books and realize there's probably information that's not in our books yet until we get our bank statement. For example, sometimes in my case, I sold one of my businesses last year. And so rather than me having to deal with handling payments from the customer, I pay a transfer agent. The person I sold it to makes payments right to that transfer agent. They handle all the interest and all that stuff. And then it just gets direct deposited in my account. And so that's a collection that's not in my book. I don't know for sure I'm getting it until I get my bank statement. I'm like, oh, there it is. Yep, the money came in. So I'm going to have to make adjustments because there'll be things that aren't in my books yet that will show up on the bank statement. Also, any interest the bank pays me, you know, that whopping 1/100th of 1% they're paying right now, or whatever it is. Bank fees, right? Sometimes you have to pay some sort of fee for your banking. That's a deduction that probably will be on the bank statement, but not recorded in your books. NSF checks, that means non-sufficient funds. Sometimes people call them bounced checks. These would be like if a customer wrote me a check and I recorded that check in my books as an increase to my cash, then my bank statement comes and I realize that customer didn't have any money in their account. And so I have to subtract that money back out. And then any book errors. So errors I've made in recording things, right? Sometimes you get that bank statement and you say, this isn't right. And then you check your book versus the bank statement and you go, oh, wait, that was my error. I recorded it wrong. So our cash balance plus any collections of interest or collections and interest minus any bank fees and NSF checks plus or minus book errors are going to give us an adjusted cash balance according to our book. And so after we make all these adjustments, then our adjusted balances should match. And this process is called reconciliation, or a lot of times they just call it bank reconciliation. So here's an example for the Video Buster company. I guess that's a play on Blockbuster or something, but I think Redbox, followed by Amazon Prime and Netflix, killed little Video Buster. Anyway, so again, the process, you look on your bank statement and you see what's the bank statement's balance. Then you're going to add any deposits in transit. And the way you do that is you look at your bank statement and you look at your books. And if there's any deposits that are on your books, but not yet on the bank statement, those are deposits in transit. So you're going to add those. Then you're going to look for outstanding checks. Again, the way you do that is you look at your bank statement and you look at your books, and any checks that are in your books already that you've written, but are not yet on the bank statement, you're going to deduct those as outstanding checks. And so that will give you your adjusted balance. Bank statement plus deposits in transit minus any outstanding checks. And also you would look to see if there's any errors. Errors are pretty rare. So in this case, there were no errors. So they have an adjusted balance of 1845. Then the next step is to look at your book balance. Again, that's what it says in your cash account, you know, for your in your books. And then you're going to add any collected notes that showed up on the bank statement, any interest you earned, subtract out any service fees. Looks like we had a check printing charge, and subtract out this NSF check. And that's going to give you the adjust. And then if there's any errors, you would adjust for those too. And then you can see once we've got the balances to match, that means we're reconciled. And so really, this is just the process we go through every period, every month usually, to make sure that our books match our bank statement. And we have to do this adjustment process to make sure it happens. And even though, like I said, computers do this for us on an ongoing basis, it's still a good process. So what most modern systems do now is I enter a transaction for this nonprofit soccer club I'll enter my transactions, and then it's tied to my bank account, right? You may use something like this, QuickBooks or Quicken, and it will go out and it will look at my bank account, and each time something hits my bank account, it will sort of come back and say, hey, it looks like a deduction came out of your checking account, and it looks like it matches this transaction you already entered. Do you want to, you know, merge the two in essence? And you say yes. And then that's how it reconciles, is by just doing each transaction by transaction. All right. One last thing is because any adjustments I made to the book, in other words, items that were not in my book and I didn't really find out about until I got my bank statement, I have to go ahead and enter those adjustments into the book. So I have to do journal entries to do that. So if we look up again, we can see we had this collected note that we adjusted our book balance for. We had interest earned, we had a check printing charge, and then we had an NSF check. So we're going to do journal entries for the collection of the note. We'll show our cash go up and our note receivable going down. For interest earned, we'll show our cash going up and our interest revenue going up. For check printing, we'll debit miscellaneous expense and credit cash. And then for the NSF check, we're actually going to debit accounts receivable because this customer now owes us this money since the check bounced, and we'll credit cash, show our cash going down. And that's really it as far as new stuff for this chapter, other than, like I said, all of that informational stuff on things like cash handling and internal controls.